There are areas in emerging markets, in corporates, in financials, where you can find overall yields north of 7-8%, even if your average investment grade yield is probably around 3.5% in euro. As we approach 2025, we think next year will continue to be one year of big challenges in macro and fixed income markets. The recent US elections increased policy uncertainty dramatically. Donald Trump won the presidency and the Republican Party won both houses, meaning most of the very well anticipated policies on fiscal, trade, tariffs, deregulation may be implemented. The policies discussed have potentially very big impact on the US economy, the global economy, and the global macro landscapes. Fiscal policy will continue to be extremely expansionary, putting further pressure on duration. Trade policy will probably be stricter than it has been in the past 2-3 years, putting pressure on currency markets, and the regulation becomes a very big question mark. So the impact on growth and equities of the new administration remains largely unclear. Very importantly, it's not clear the if, the when, and how much of these policies being implemented, and these will continue to create a lot of uncertainty with a consequent increase in volatility across asset markets. So as we enter into 2025, not much is clear about economic policy, and volatility will continue to stay elevated. Generally speaking, we are not fan of duration here for 2 reasons. First, we do think US monetary policy is probably too loose. The Fed started with a 50 basis point cut. That was probably too much. When you look at inflation and inflation expectations, they have been moving up since the first cut. US macro remained pretty strong. The labor market is at equilibrium levels. And at the same time, the new administration will run policies against immigration, against trade, and pro-fiscal. And those 3 elements are all inflationary. So for the Fed, it will be harder and harder to cut interest rates in a sustained manner. And what initially felt like a very big and deep cutting cycle in the US will probably turn to be only a mid-cycle adjustment where interest rates go down by 1% in total. Remember, they went already down 0.75. So the scope for further cuts is limited. That's bad for rates. Second, there is no fiscal premium in the US curve. It's important because fiscal has been discussed a lot over the past 1, 2, 3 months, but the 210 part of the curve, so the spread between the 10-year treasury and the 2-year treasury, is around 0, meaning the market is now assigning no premium for holding very long paper in US vis-a-vis very short paper. We do think as the market realizes that Trump is serious about tax cuts, about spending hikes, and about the role of government to support the US economy, bond vigilantes will show up and duration will start suffering. So the market will need a bigger premium on 10-year paper, on duration, basically to hold those long-term assets vis-a-vis short-term assets. So monetary policy becomes less loose, fiscal policy becomes looser, the net impact is interest rates go up. So cautious on duration. Credit markets are somewhat in a better place because the overall level of yield that can be found in those markets is better out of the combination of historically high interest rates and decent spreads. What's the problem? The problem is that spreads have been tightening a lot over the past 18 months and now they sit close to the low end of the 5-year range. So the premium to hold credit risk is not there anymore and the overall level of yield is optically attractive, but what investors get entering the asset class has now more risks than reward, definitely compared to 12 months ago. The good news is that the dispersion in credit remains relatively high. In 2021, the level of spreads were very similar to the level of spreads today at market level, but dispersion was 0 and now dispersion is higher. There are areas in emerging markets, in corporates, in financials, where you can find overall yields north of 7-8%, even if your average investment grade yield is probably around 3.5% in euro. So the overall level of spreads and yield in the market is not satisfactory anymore. The circle of assets where fixed income investors can find value is definitely tighter than it was 2 years ago, but there are pockets of value, areas of value. So we do think investors will need to focus on these areas, and active management and selectivity remains key into 2025. To sum up, duration has more risks than rewards, and rates volatility, macro volatility will remain high. Credit, better place, but the being long trade is done. It played out in 2024. The next trade is a trade in which the bond pickers basically come out. You need to pick the good bonds, the bonds where there is still spread and value, vis-a-vis the bonds that are tight. So flexibility, selectivity, the key into 2025.